By now you've probably heard of Ramit Sethi. He has a new Netflix series coming out on April 18th called How to Get Rich, based on his 2009 book, I Will Teach You to Be Rich. I'm afraid that not quite everything he preaches will actually teach you to be rich, particularly when it comes to paying taxes in retirement. He recently posted a graphic on his Twitter feed entitled Ramit's Rules for Taxes. As you will soon see, he gets part of the retirement formula correct, but leaves a few gaping holes. And I'm afraid these gaping holes could unwittingly cause an entire generation of Americans to run out of money sooner than they ever thought possible. Let's take a look at each of Ramit's rules for taxes, one by one. First, I'm thankful for every dollar I get to pay in taxes. Look, I get what he's probably driving at here. Taxes are what help fund government, infrastructure, roads, schools, and social safety nets. And since he's thankful for all of those good and noble things, he should therefore be thankful for every dollar that he pays in taxes that help fund those things. Look, I don't want to make a social or a political commentary here. I want to make a financial commentary. You are under no obligation, according to the U.S. tax code, to pay a single dollar in taxes above and beyond what the law requires. And if you approach the act of paying a tax in a willy-nilly way, particularly when it comes to retirement planning, you could unwittingly set yourself on a course that bankrupts you years in advance of life expectancy. I understand that he's not necessarily saying that he wants to pay as much tax as possible, but if you take a laissez-faire approach to paying tax to the federal government, you will invariably end up paying more tax than is absolutely required by law. And this will dramatically affect the amount of money you get to spend in retirement. Consider, for example, if you have a financial advisor who warns you that taxes even 10 years from now are likely to be twice as high as they are today. Therefore, you should develop a strategy that systematically repositions your retirement accounts to tax-free. To which you respond, look, I appreciate your concern, but I'm thankful for every dollar I get to pay in taxes. Perhaps think about adopting the following attitude instead. I want to be as proactive with my tax planning strategy as possible so that in retirement, the IRS gets as little of my money as is legally required. In short, you have to be vigilant about legally reducing your tax burden at a time in your life when you can least afford to pay it, in retirement. Okay, second, take advantage of all tax advantage accounts, then move on. All right, I like the spirit of what he's saying here, but I think he's a little short on details. Generally, when a financial guru says take advantage of tax advantage accounts, they're talking about Roth IRAs and Roth 401ks. Those things are to be commended, but they're only 2 of 6 streams of tax-free alternatives that are available to you. He makes no mention, for example, of leaving a minimal balance in your tax-deferred bucket so that in retirement your standard deduction can offset your RMDs. He also makes no mention of cash value life insurance, and based on the following tweet, I can infer he's not too high on it. Here he says, dudes will agonize over giving an interest-free loan to the government of $2,800, but put 30% of their money in an IUL they heard about on TikTok and pay 1.75% AUM to her brother-in-law, Chet. Now, as I've said in past videos, I have huge problems with the IUL agents on TikTok, but let's not throw the baby out with the bathwater. More on his tax refund take here in a bit. All right, third principle, don't let the tax tail wag the dog. All right, folks, I've been hearing this platitude for the last 25 years of my career, and it's one of my biggest pet peeves. I get things like don't move to Florida or Tennessee just so you can save on state tax, but the problem is when people hear this constant drumbeat of don't let the tax tail wag the dog so much that they end up doing nothing when it comes to shielding their retirement savings from the impact of higher taxes in the future. They get one of the most important decisions in their financial lives completely wrong: the timing of tax payments on their retirement savings. Do you pay those taxes now while taxes are historically low, or do you postpone the payment of those taxes to a point in the future when taxes could be, according to many experts, dramatically higher than they are today? Now, granted, timing of tax payments is hardly the only thing you need to worry about in retirement. You should be equally concerned about making sure you have a plan for not running out of money before you run out of life. But here's the rub. If you fail to make an informed decision on the timing of those tax payments in retirement because you were afraid of letting the tax tail wag the dog, then you actually will run out of money much faster than necessary. In short, if the financial community could ban the words, "Don't let the tax tail wag the dog," from their collective vocabulary, more Americans would focus on the reality that taxes will be higher down the road and would take the steps necessary to shield their retirement savings from the impact of higher taxes. Fourth principle, there's nothing wrong with getting a tax refund. Okay, this is another thing that drives me absolutely nuts. This advice violates the very laws of the investment universe. Why? 2 words, opportunity cost. When you get a tax refund at the end of the year, the government doesn't send interest along with it. As Ramit rightly notes, you basically gave the government an interest-free loan for a solid year. Now, this won't sink your ship if it happens 1 or even 2 years in a row, but what if you did this every year between now and when you retired? It would potentially cost you hundreds of thousands of dollars in opportunity costs. This is not the type of advice you should expect from a quote-unquote financial guru. Fifth, hire an accountant. Okay, if you're a business owner, definitely hire an accountant. But when it comes to retirement planning, accountants can really sink your retirement ship. Here's why. Most accountants I've met are stuck in the tax-deferred paradigm. Their goal is to save you as much tax as possible today so they can keep you as a client. If they recommend you do a Roth conversion or contribute to a Roth 401k instead of traditional retirement accounts where you get a tax deduction, you'll pay more taxes today, not less. And a CPA believes that their most important job is to save you taxes today. That paradigm, of course, is completely at odds with a tax-free paradigm. A tax-free worldview says, look, because of unfunded obligations for Social Security, Medicare, and Medicaid, taxes in the future are likely to be dramatically higher than they are today. So pay taxes at today's historically low tax rates so you can avoid much higher taxes when you spend down your accounts in retirement. What you really need is a financial advisor who understands the following 2 principles. First, taxes even 10 years from now are likely to be dramatically higher than they are today. And second, the best way to shield yourself from those higher taxes is to create a strategy that takes advantage of today's historically low tax rates by repositioning your assets to tax-free. That strategy may include Roth IRAs, Roth 401ks, Roth conversions, offsetting RMDs with standard deductions, and yes, cash value life insurance. By the way, if by using all those streams of tax-free income, you can stay below the provisional income thresholds, you can get your Social Security tax-free as well. Make it your goal to get to the 0% tax bracket in retirement. Why is the 0% tax bracket so powerful? Because if tax rates double, 2 times 0 is still 0. Now, that's what I call the power of 0. In summary, Ramit Sethi may be a lot of things, but a tax-free retirement specialist he is not. His love affair with the IRS could force his unwitting listeners to ignore, or at the very least, not understand the importance of getting absolutely correct the timing of tax payments in retirement. If you want to learn more about how to shield your hard-earned retirement savings from the impact of higher taxes, be sure to check out my tax-free toolkit. You can download it for free at taxfreetoolkit.com. If you're a financial professional and want to learn how to become a certified Power of Zero advisor, head over to powerzero.com and opt into my free 3-part video series. By the way, if you have any comments or questions, feel free to drop them into the comment section below. I respond to every single one of them personally. And don't forget to click like, subscribe, and the bell so you never miss a video. This is David McKnight. I look forward to seeing you on the next video.